Nothing in this program should be considered investment advice. It is for educational purposes only. Please hit pause and read this disclaimer in full.
That's a major warning, and something that unfortunately passive investors and those caught up in the hype are not even going to take into consideration because it's either not on their radar or it's not what they want to hear.
Welcome, everyone, to this episode of Finance U. I'm your host, Chris Martinson, where we endeavor to do everything we can to make finance and economics and portfolios as understandable as possible. And back with me, of course, is my weekly side guest here every week, Paul Kiker of Kiker Wealth Management. Hey, Paul.
Good to see you, Chris. It's such an honor to see you on a weekly basis. It really is.
Indeed. All right. Well, Paul, you know what I want to talk about? This AI super bubble. Unfortunately, I was in a little bit of a scramble, so I didn't get to put slides together for this. So what I'm going to have to do is turn instead to my source for these things, where I would have put the slides together anyway. You probably saw this. This was in Bloomberg. Chinese hedge funds, for whatever we think of Chinese hedge funds, they warn the AI super bubble is ready to burst. And they just say, they're just looking at this thing. They're like, this just doesn't make any sense. And it's because it's concerns over valuations and lack of a long-term moat for some AI infrastructure companies. I've been tracking this pretty closely. What we've been seeing a lot lately, Paul, is that Anthropic, OpenAI, they have to charge for the tokens, right? And it turns out that China's got these open source models where the token costs are just a fraction, right? Plus, we're starting to see things like, I think it was Ford. They just rehired a bunch of engineers because they thought they were going to replace them with AI engineers. Didn't quite work out, so they brought the humans back. So I think companies are starting to find out what AI can and can't do, honestly, realistically. And also, there is no moat for these companies. There's no way that, the whole thing's progressing so quickly.
Right.
But they're just pointing out that there really isn't a business plan here that anybody can sink their teeth into that squares the circle.
No.
At present.
I pay attention to the Chinese hedge fund managers. Look, in all the institutions, they have the reputation for being the best at math, best at engineering, the best at long-term thinking, because that long-term thinking is just built into their culture from a young age versus the short-term thinking inside the United States. So that's a major warning. And you're right. The nature of technology is always going to be aggressive because, as we're seeing right now, on any given day, some new advancement can make the current process or technology obsolete, and it's moving so fast at this point that it's just a matter of time. And I'm seeing reports all over the place that it's too expensive for the data compute cost, and hey, we made a mistake. We need to bring some employees back online here. And that may be good for employment. Kind of like 2000 to 2003, that was a pretty major recession. Markets responded dramatically, but the average person didn't really feel that recession. We could be back in that situation where unemployment holds up, or employment holds up, unemployment stays relatively low. But information technology stocks, which are the market at this point, they've never been this high percentage of the S&P 500 ever, nor any other sector this high. If that was to go down back to normal levels, you're talking about major declines in the overall indexes.
Jeremy Grantham had some pretty pithy warnings. He was all over the news recently, the grand maven of it all. No less than the BIS came out, and this was in a Financial Times article, and I also read the BIS report. They said, quote, financial stability because of the AI bubble could be at risk in the event of an AI bust. Financial stability. So when the BIS says financial stability, they're talking like a great financial crisis kind of a moment. They're talking systemic risk. They said, quote, should hyperscalers slow or even halt the aggressive pace of CapEx deployment, many borrowers across the supply chain could struggle to replace lost revenue and service their debt. So, yeah. Roger here says, let me put it in simple terms what the BIS is saying here. The AI bubble is now a self-feeding disaster that can't be rescued. Hyperscaler must borrow and keep increasing CapEx higher every quarter for eternity. Every quarter, the situation grows more disastrous, but the entire financial system risks collapse the second the debt ends. It's unavoidable. It's a pretty stern warning from the I'm not used to the BIS giving me warnings about
me
things
either.
Like this.
Me either, but that's a major warning. It really is. and something that unfortunately passive investors and those caught up in the hype are not even going to take into consideration because it's either not on their radar or it's not what they want to hear.
Yeah. I mean, it's just, we're struggling. I struggle, Paul, to find the right words because how many times can you say unprecedented? You know, it's like we're in territory, which is just so, let's put it this way. Here's a nice little chart. Select historical technological investment waves. Here's the railroad coming in. This is percent of GDP, right? So we had the railroad. This is the telephone bubble. It was a big thing. It doesn't look so big on this. Cars, back in the days. Semis and semiconductors back here in the 90s, 2000, coming up into 2000. But look at this AI software. Now clocking in at more than 8% of GDP. Just to put it in perspective, we've never seen a bubble like this before. We've never seen a rush into a technology like this before, ever.
And the railroad bubble was massive, right? There was tons of wealth, and it was dramatic in its impact and change of the underlying economy. But we're yet to be proven on the AI software investment in this bubble where we are right now. I mean, if it's 50% of what they anticipated with the way that they've gone in, yes, it's going to change the way we do business. I mean, the tools are incredible in how they've helped us to be more efficient in certain sectors, but they're not the holy grail that it's been projected to be at this point.
We keep talking about it, but there's the Buffett indicator. It just hits new highs every time, every week. Paul's it's hitting a new high. Buffett says we've never had people in a more gambling mood than now.
Yeah.
Never. So we saw that with the margin debt, just spiking to all that. People are going all in on this. And that's why that chart over your shoulder, that's why you get that spike at the end. People get greedy. They just can't miss out on it. Everybody's saying, I can't resist anymore. One of my favorite stories was that way back in the South Sea bubble, Isaac Newton, now pretty smart guy. He invented calculus among a lot of pretty smart guy. He saw the bubble for what it was and he got out. And then he got back in. He couldn't resist. He probably went to one too many parties. It was a nice, attractive young lady asking him how many South Sea shares he held, and he realized he was left behind. So he got back in and he lost all his money.
Yeah.
Smartest guy. Yeah. Being smart is no defense.
No, it's not. And we're all susceptible to this, Chris. I mean, it's human nature. And that's the reason these bubbles and cycles continue. And then, yes, it's different in some ways. It's going to rhyme. It's going to be different because it's not an exact repeat. But it's those human emotions that push things to the end, and we can't help it. And I would venture to say, if we could go back and interview him when he sold and then things took off, when he got back in, he's like, I'm not going to make the mistake this time. I'm not going to get shaken out. And that's what makes it so painful on the other side, because when the last bit of people come in and you get that burst of people that are in, they're not willing to sell. And then you've got that last margin that jumps into the game. They can't take it anymore. That's that moon shoot that you get. And then those same investors are like, I'm not going to make a mistake and get shaken out. So it sells off and you get a little bit of a rally, and it sells off and you get a little bit of a rally. And then all of a sudden, they've got decades of underperformance and they're down 50, 60% before they realize that they made a mistake. I mean, Stan Druckenmiller, one of the most legendary, successful investors of all time, outside of George Soros, Warren Buffett, and I know George Soros I'm not a fan of his, but he was a legendary investor. Druckenmiller worked for him. He shares in the year 2000 how he got sucked in just because of emotions. He got tired of watching all the younger guys make all this money in the interim period. Right, I think if I remember correctly, he top-ticked the turn of the market, and they asked him, what lesson did you learn? And he said, I didn't learn the lesson because I knew I shouldn't have done it anyway. I just let my emotions take control. And the good thing is he reacted quickly on the other side, but it was still a very painful experience for him.
Yeah, well, that's why it's best to have a plan. You got to have a strategy for this stuff. This. What else can I tell anybody listening, Paul? We're in a bubble. We're clearly in a bubble. And lots of people know it. And we're getting all the warning signs, So again, if or when it breaks, in my mind, people will look back and go, oh, if only there'd been some warning signs. There are plenty of warning signs.
what I would tell people is say, hey, look at your current investment strategy. If you've got an advisor and you're concerned about, all of these warning signs in context of history, they are warnings. You cannot say that you haven't been warned. Okay. If you've heard this information, you have been warned. Now, to lay the backdrop. So before I get there, if you've got an advisor, talk to your advisor and say, hey, at what point, do you have a strategy to sell? If it's not different this time and we are in the midst of a bubble, can you demonstrate to me how you would sell and move into a defensive mode or a capital preservation mode? Now, that advisor may say, I'm not. We're going to be passive. We're going to stay invested at all times. They're going to give you all kinds of statistics, which will be true in the context of history. They'll probably say something like, there's never been a 25-year period of time in history where the markets didn't go up. Okay, so that is true. But the question is, if you're 65 or 70, or if you're 60, how old are you going to be at 25 years? And if there is a 50% decline in there and you're in the distribution phase of your investment life cycle, can that cause you to run out of money? Look, if you're 25 or 30 or 35 and the market goes sideways for 25 years and you're dollar cost averaging in, absolute single best thing that can happen to you because you're buying massive numbers of shares over that period of time before the markets start taking off. So that's the first question I'd ask. And if they don't have a downside risk management, then you have to put yourself in a mental exercise and say, okay, what if it's not different this time and we go back to normal valuations, which is 50% below here? How am I going to feel? Am I going to feel foolish? Because, and if that's the case that concerns you, or you stress test your situation and that could put your retirement at risk, then consider other alternatives. Okay. The alternative to a risk managed strategy is when in periods of time like this, we're going to dial that risk back down and you might miss a little bit of opportunity. Okay. So it's either a little bit of emotional pain on the front side and having the discipline to stay the course, or it's a lot of emotional pain on the other side. Investing, there's no holy grail to investing. You're going to endure some emotional pain and you're going to have the discipline to go through that. The question is, what type of pain are you willing to endure? Okay. Is that the pain of your retirement potentially being wiped out if valuations go back to normal? Okay. There are things, if you want to stay passive, there are things that you can do to build resiliency in there, but implement those now. Implement them when it's easy to sell, when valuations are high, and prepare yourself. On the other side, if you're not okay with that outcome on the passive side, then find some people that run tactical strategies and interview them, find one that makes sense that you'd like to work with, and move forward in that. Because if you're in the passive bubble, this thing will probably end quicker than you think it will. If you're in a tactical strategy and you're cautious, it's probably going to last a little bit longer than you think it will. So it's going to take discipline on either side. And that's what investors should be doing right now, is examine your strategy, put it in the context of your individual situation, not what's best for Wall Street, not what's best for your brother-in-law, not what's best for your best friend at work, what's best for you and your circumstance. And that's the reason why we do that retirement plan analysis, is because I'm pulling people to their circumstance, not somebody else's.
All right. Well, Paul, thanks so much for your time today. It's been a pleasure talking to you again.
It's my honor, Chris.
And have a great week and weekend, and we'll be back with you next week.
And yes, happy 250th 4th of July.
I just suddenly thought of all the stuff set up on the National Mall, and I had a little hitch. I don't know if you've seen it.
I haven't seen it yet. No, I'll have to search it out after we get off here.
It's a little disappointing, but just to me. So, all right. Yes, happy 250. Have a great 4th of July. It's going to be fantastic. Until next time. Bye, everyone.